Welcome back to the club, where investing is clear, simple, and open to all. I'm your club manager, and today we're tackling one of the biggest challenges in investing, market volatility. What's causing these wild swings? How do major players like Trump, Powell, and global markets fuel the chaos? And most importantly, how can you stay ahead in uncertain times? This is Investment Club, no fees. Let's break it all down. Volatility is the name of the game, but what's causing it this time? The key players are stepping onto the stage, and their actions or inactions are sending shockwaves through the financial world. Let's start with Donald Trump and his impact on the markets. Recently, Trump made it abundantly clear. There will be no Trump put. That's right, no artificial efforts to prop up the stock market. This is a stark contrast to what many expected based on his previous tenure, where markets soared under his tax cuts and deregulation policies. Treasury Secretary Bessent backed up this stance, emphasizing that the administration is focused solely on 10-year Treasury yields, not stock market performance. Think about that. The man known for his market-friendly approach is now effectively telling investors, "You're on your own." But is that the full picture? Not quite. Meanwhile, Fed Chair Jerome Powell has taken a different approach. Powell's recent speeches have reassured investors that the U.S. economy remains strong. He acknowledged uncertainty but downplayed economic fears, stating that short-term inflationary spikes should not be overinterpreted. This reassurance sent markets climbing, right at the moment Trump's administration distanced itself from intervention. It's almost ironic, isn't it? Trump wants to step back, yet the markets are rallying on Powell's words. It's like watching two heavyweight fighters trying to land the biggest punch while pretending they're not even in the ring. Let's shift gears to the economy. The big question, will the Federal Reserve cut interest rates anytime soon? The short answer, probably not. Powell has hinted that rate cuts are unnecessary at this stage, despite market expectations. But here's the kicker. If inflation remains sticky while the economy slows, we could see an economic downturn. Look at the data. The latest unemployment rate ticked up slightly to 4.1%, higher than the expected 4.0%. Wage growth has slowed, reducing inflationary pressure. Consumer spending indicators are flashing warning signs. People are feeling the pinch. So what does this mean for investors? If rate cuts don't happen soon, market volatility could intensify. The S&P 500 and NASDAQ reacted almost instantly to Powell's recent comments, swinging dramatically. The takeaway? This is not a market for the faint of heart. Just when you thought tariffs were old news, Trump reignited trade tensions. Recent statements indicate that tariffs on Canadian and Mexican imports could be reinstated. Yes, including on goods like dairy and lumber. Why does this matter? Because tariffs increase inflation by raising import costs. If inflation spikes, the Fed may be forced to keep rates higher for longer, creating a ripple effect across all asset classes. Let's talk about China. Unlike previous years when Beijing would react swiftly to U.S. tariffs by devaluing the yuan, China may be holding firm this time. This could limit their ability to absorb tariff shocks, making U.S. consumers feel the full brunt of price hikes. And here's where things get tricky. If inflation rises due to tariffs and the Fed refuses to cut rates, stock markets could tumble further. That's the worst-case scenario, stagflation, a nightmare for investors. What's happening in alternative investments? Two major themes. 1. Trump's crypto pivot. Trump has promised that the U.S. will not sell its Bitcoin holdings, a major shift from previous skepticism. This move is meant to position America as a crypto superpower, a bold play in the digital asset space. 2. AI stocks and tech volatility. AI-driven stocks like Broadcom, Nvidia, and Microsoft remain market darlings. However, as interest rates remain high, these stocks face increased pressure. The days of easy gains in AI may be coming to an end. Key takeaway? Diversification is crucial. Relying on tech alone is risky. Allocating across sectors will be essential for long-term success. Now comes the golden question. How do investors survive and thrive in volatile markets. Look at bonds. With the 10-year yield becoming a primary focus, bond investing is making a comeback. As yields fluctuate, bonds offer stability. Beware of overhyped stocks. AI and crypto will continue to dominate headlines, but disciplined investing means avoiding FOMO-driven trades. Stay agile. Market swings will continue. Instead of reacting emotionally, use these opportunities to accumulate strong assets at lower prices. Markets are moving fast, and the stakes are high. Between Trump's trade policies, Powell's careful maneuvering, and economic uncertainties, the only certainty is more volatility. But remember, with volatility comes opportunity, and that's a wrap for today. If this deep dive helped clarify the market's twists and turns, be sure to like, subscribe, and hit that notification bell. Stay tuned for more insights from Investment Club No Fees, where we keep investing simple, clear, and open to all. See you next time.